In this video, I'll break down the difference between investing 1.0, 2.0, and 3.0. Now, if you ever heard the phrase Web 1.0, 2.0, or 3.0, that kind of breaks down how the internet has evolved over the last few decades. Well, with investing 1.0, 2.0, and 3.0, it breaks down how the investing industry has changed over the last 200 years. Now, I'm not going to make a 2-hour video here. I'm just going to kind of highlight some of the differences between each, but it might give you context on what type of investor you are, either 1.0 investor, 2.0 investor, or 3.0 investor. Before I dive in, if you don't know who I am, my name is Tepper and I'm the founder and CEO of Tykr. If you're new to investing or want to get better at investing, rest assured you're in the right place. Here at Tykr, we help people buy and sell stocks with confidence. All right, let's get into it. We'll start with investing 1.0. This spanned between 1790 and about 1990. This all started with the Philadelphia Stock Exchange, which was established in 1790. Soon after, in 1792, the New York Stock Exchange was established. That still stands, but the Philadelphia Stock Exchange does not. All right, if an investor wanted to buy and sell stocks, of course, there was no internet, so where do you go for homework? Well, you would read the newspaper. They would usually release what's the latest news on different stocks, and there were ways you could buy and sell stocks. You'd have to call up a stockbroker or go to a stockbroker, and they would buy those stocks for you. It's all on paper, but you would get all your information through newspapers. And then get this, in order to get your earnings reports, you have your 10Qs and 10Ks. The 10Ks are the annual reports, and the 10Qs, Q for quarterly, those are the quarterly reports. Well, those were not in newspapers, of course. So where do you go? Well, you would go to the library. You could read those long documents. A really fun way to spend a Saturday. Just kidding. But there was a lot of information there you could find in the newspaper if you wanted to go deep and research stocks. All right. Fast forward to the 1960s, this is when efficient market theory came about. So what is efficient market theory? Efficient market theory pushes back on what Ben Graham, Warren Buffett, and the late Charlie Munger taught us about value investing, which is there are many cases where the share price is different than the fair value. And we have to pay attention to that fair value, not the share price, because that's the actual value. And you have to use, for example, one person I really respect a lot, aside from Ben Graham, Warren Buffett, and Charlie Munger, is Phil Town. He really taught us how to use the profits to calculate the fair value. So in Tykr, we actually show different ways to calculate it. We have a projections tab. But anyway, the share price is very different from fair value. But yeah, there are people saying that, yeah, there is no difference. The price you see is the price you get. No. That's not the case. True value investors and the investors that have found the most success in the market treat price and fair value differently. But anyway, that was efficient market theory that came about. Just after that, this is when some of the larger institutions we all recognize, or most of us recognize, started to come about. So Charles Schwab was founded in 1971. Then May Day, which was May 1st, 1975, which required brokers to all charge the same rates or fees to customers to buy and sell stocks. Of course, in order to do that, you had to call your stockbroker. That's not really a thing anymore, and we'll get to that in a second, but they would buy and sell stocks for you. And then another big broker that was founded around the same time, 1975, which is Vanguard. All right, so that's 1790 through 1990, which introduces investing 2.0. So this is the transition from stockbrokers to online brokers. Thanks to the internet, the early 1990s really introduced investing 2.0. This is where some of the brokers like Charles Schwab and Vanguard, they came a little later, allowing people to buy and sell stocks. But the first two players were Scottrade. They were founded in 1980. Of course, you had to call your stockbroker, but they introduced online trading, so you could buy and sell stocks on your own. They introduced in the early 1990s, and then they eventually sold to TD Ameritrade in 2017, and then TD Ameritrade sold to Schwab in 2020. All right, another broker at the time, E-Trade, founded in 1982. They also introduced online trading in the early 1990s. So overall, Scottrade and E-Trade really led the way in the beginning. And E-Trade eventually sold to Morgan Stanley in 2020. Of course, you fast forward about 20 years later, then all these new brokers started coming out or introducing the ability to buy and sell stocks on your own. Fidelity, Interactive Brokers, Robinhood, Tasty Trade, Tradier, TradeStation, Webull, Moomoo, Zeroda. I mean, there's a long list, and we're actually in Tykr. We're connected to a lot of these brokers, but a lot of these players started making it easier for people to buy and sell stocks. All right, now let's break down, still in Investing 2.0, the growth of the retail investor market. Thank you, brokers, all of you. If you work for a broker or you're affiliated with one, thank you for the hard work, because you've really made it easier for people out there to buy and sell stocks on their own. That was really 2.0. People are like, yes, I can join a broker at low cost or no fee, and I can start buying and selling stocks on my own. So here we go. In 2010, 2% of global assets in the market were from retail. You have retail investors and institutional investors. Institutional investors are large financial institutions. They're the entities that are moving share prices up and down the most. So when you see share prices in your broker, or if you're using Tykr, you see the share prices jump up and down from one day to the next. It's primarily institutional investors. However, that has changed over time. So it was 2% in 2010. You go 9 years later, it jumped up to 4% in 2019. Then because of COVID, in 2020, it jumped up to 19%. And that's when a lot of these brokerage firms started introducing free trades. And Robinhood was one of the key leaders there that drove that. The dominoes started falling thereafter. But a lot of brokers are like, we can't keep up with that. We can't charge people. Well, we got to make it low fee or free. So even though, and I'll give context here, even though a broker is advertised as free, it's not really free. There's still a spread fee or payment for order flow that can be behind the scenes. And that's typically fractions of a cent. You and I, as retail investors, we typically don't feel it because it's so small. I'll give you an example here. I won't name the broker, but I have some of these numbers memorized. This particular broker charges their spread fee is 0.0006 cents. So do you and I care about that? No. But when you have hundreds of thousands of people or millions of people making trades in a given day, that adds up. And that's why brokers, one of their biggest revenue streams in most cases is still transaction fees. But anyway, so that jumped to 2024, over 50% of global assets, and this is from the World Economic Forum has stated that, over 50% are now from retail. And I did a little analysis on my own. I created a list of brokers, about 25 brokers, and I went to each site to understand how many users they have on the platform. And after I got through that list, I found that there are about 300 million retail investors on just the top 25 brokers around the world. So it's a big number of people that have joined the stock market. All right, let's keep going here. Moving to some other details around Investing 2.0, it introduced algorithmic trading and high frequency trading. So what does that mean? Well, that really is large institutions using computers to make large purchases automatically without a human being involved. So they'll set like triggers, like if share price hits this, or if revenues hit this, or let's say an earnings report comes out and you have a positive EPS, it's increasing and they beat their earnings, then buy X amount of shares of this stock. That's all automatically in place. And it's a little more sophisticated than what I described, but it's automatic and it's en masse. There are a large amount of shares happening. So that was all part of 2.0. And also part of 2.0 is crypto trading. So some of the big brokerages that came out between 1990 and 2020, you've got Coinbase, Binance, Kraken are just a few. Then you move on to robo-advisors like Acorns, Wealthfront, and Betterment. What they allow you to do is you connect your bank account and then they automatically deposit a little bit of money into a select bundle of index funds or ETFs. There's not a whole lot to choose from. Like a broker is going to give you a lot of options, like a big menu. If you go to a restaurant, you can pick all these options. Well, with a robo trader, you only get a few options and they do it automatically. So if you want to do that, you can. But in my opinion, a broker gives you a lot more freedom, a lot more control. All right. So 2020 was kind of the trigger point to transition from 2.0 to 3.0. So here's what encompasses 3.0. It kind of started in the 2010s, of course, with these brokers coming out, but now people are getting smarter. Number one is efficient market theory is really falling out of favor. People are realizing that, value investing is a thing. Warren Buffett, the late Charlie Munger, and a lot of other value investors, they've made billions by using the fair value as a criteria to find stocks. So we have a fair value that's higher than that share price. The difference is the margin of safety, and you want a margin of safety of 50% or higher. We actually automatically show that within Tykr, but there are investors that are becoming wise to that and realizing that, efficient market theory, it's not really a thing. There are still people that believe in it, but yeah, it's not really a thing. All right. Also, another thing that has fallen out of favor are bonds. So get this, average returns of bonds are typically less than 3% per year over the last 10 years. And a lot of institutions, in fact, I found an article from CNBC that talked about the whole 60-40 portfolio, 60% stocks, 40% bonds. That's dead. They're not even recommending going into bonds anymore. And they're not alone. There's a lot of people that are saying, yeah, like bonds, they're not really a thing either. If you want to invest in bonds, sure. But I tell people a safe play may be to simply just go into the S&P 500. Again, not financial advice, but just what I would do. All right. And then moving on to people are actually becoming wise between the difference between wealth building and wealth protection. They're two different strategies. There's people that would kind of treat investing in the stock market as one main strategy. It's like, no. It's very different. So at Tykr, we actually draw a very fine line in the sand and tell people wealth building mode is when you are in your 20s, 30s, or 40s, maybe 50s. You want to make up some time. And you have a retirement timeline that's 5 years out or more. In that case, you want to be in about 10 to 15 stocks. For context, Warren Buffett, he made his first million investing in about 10 businesses. He was investing in private companies, not public, with his first business. But anyway, it's all about being focused. As you near retirement or financial independence, if you're 5 years out or less, then you want to consider moving to index funds or ETFs, and a lot of financial advisors that use Tykr recommend this, which I love this strategy, which is just hold those stocks, maybe buy a few more, but make sure they're all dividend stocks, because you can simply hold those stocks and get paid a dividend every quarter. So you don't have to sell any shares to enjoy your life, to travel, to enjoy your hobbies, and do whatever you want. So there's a big difference between wealth building and wealth protection. All right. And this is a big one. People want results. So with Investing 2.0, the excitement of joining a broker was there. It's kind of like the analogy I use is you get invited to a party. You're driving or you're traveling or working your way to the party. You're excited. You can't wait to get there. And then when you get there, it's like crickets. You don't know anybody there. You don't know what to do. That's with most people, unfortunately, that join a broker. It's very exciting. You're going through the onboarding, you join, but as soon as you're in, it's like, okay, so what do I do next? Well, people want to know what to do. They want guidance, they want help, and that leads to the increase of better screener tools out there. I'm biased here, so Tykr I'm going to put at the top of the list, but I'll always say good things about our competitors. Seeking Alpha has done a great job with analyst reviews. You can look up a stock, you can see a list of analyst reviews. You can also go to Motley Fool. They've got a lot of different products. They're focused on value investing, very focused on value investing. You also have Simply Wall Street. They're out of Australia. They've done a nice job, really attractive looking platform, but people want to use tools that actually help them find stocks that generate results. They don't just want to join a broker, they actually want results. And that's becoming more of a mandatory thing or highly requested with retail investors these days. And I love that when people are like, yeah, I don't just want to join a broker and feel like I'm part of a party. I actually want to do something with my wealth. And then this leads to an obvious one with Investing 3.0, which is the use of AI to save time. At Tykr, again, biased, we have a tool called the 4M Confidence Booster. We look at the 4 M's of investing. You get that math part, which we do automatically. Then we have the second M, which is the meaning, which is how the business makes money, how scalable the revenue streams are. Then we have the moat. How does the business compare to other businesses in the same sector and industry? And then that leads to the last M, which is the management. That's the track record of the CEO. So we pretty much take hours, if not days of research and reduce it down to seconds. But there are other tools out there. We're seeing other platforms that are coming out with AI assistants where you can ask it questions like, hey, give me a bundle of like 10 industrial stocks or 10 car stocks or whatever. And it'll just kind of bam, create a list. And you've got a few options. They're not going to give you financial advice, but they're going to give you a few options to choose from. So AI is definitely becoming more popular. We plan on doing more with it. It is exciting, but we want to make sure that it's not a kitschy like marketing play, which drives me crazy when people say, hey, we're using AI to invest. It's like, what are you doing? Saving people's time, or are you just adding it to your business name to sound fancy? Anyway, so there you go. There's a breakdown between investing 1.0, 2.0, and 3.0. I'd love to see in the comments, where do you fall? Are you investing 1.0, going back to the late 1700s? You like your newspapers to research stocks? I'm just kidding on that. But maybe some of you like your bonds. Maybe some of you are in that state where you're 2.0. You join a broker, you don't know what to do next. You want to move to 3.0, which is you join your broker. Now you want results. You want to find a tool that helps you do that. That leads up to this. Of course, if you want to buy and sell stocks on your own with confidence and even see my portfolio, you can join Tykr for free. Of course, don't buy and sell stocks based solely on what you're here. Only buy and sell stocks that align with your own personal financial goals. Thanks for checking out this video. We'll see you in the next one. Bye for now.